The Federal Reserve announced its first interest rate cut of the year yesterday after the central bank's highly anticipated two-day September policy meeting. The Fed lowered its benchmark rate by 1/4 percentage point to a range of 4 to 4.25%. The 12-member board voted 11-1 to cut rates and signaled 2 more cuts are expected before the end of the year. Trump's newly appointed Fed governor, Stephen Miron, was the only dissenting vote. He was in favor of a larger half-point cut instead. Steve Ratner, you have charts on all of this. I guess let's start by explaining the cut that we got yesterday.
Yeah, Mika, it was actually a surprisingly uneventful meeting after all the buildup. We thought there might be more dissension, more controversy. As you know, Trump has been kind of trying to pack the Fed, so to speak, and try to get faster cuts, more cuts, and so forth. But he didn't really get it yesterday. And as you said, only one governor actually sided on this, in favor of more cuts. So here's the cut he did yesterday. And as part of it, every quarter, the Fed issues new projections for where it thinks interest rates are going. And you can see the glide path has been pretty similar. It bounces around a bit from the March to the June to the September estimates, really based as much on Trump and the tariff wars as anything else. When the tariff wars seemed greater, we thought interest rates would stay higher. Now they seem to be a bit less, interest rates coming down, and then they stabilize over here. But as you also said, what's happening now is the Fed is pivoting from worrying about inflation, rightly or wrongly, to worrying about the jobs market. And so you can see over here what's been happening to the jobs market. Now, obviously, when you go back to 2021, we had a lot of COVID effects, reopening of the country. But these are annual rates of job creation over that period of time. And you can see that back here, we created about we were creating 216,000 jobs in the course of 2023 per month, dropped to 168,000 here, drops to 75,000 here. And in the last 4 months, when, of course, we all remember Trump fired the head of the Bureau of Labor Statistics, we created only 27,000 jobs a month on average. Why is that happening? You'd hear different reasons. It's very anecdotal at this point. Certainly, businesses holding back on hiring because they really don't know where the economy is going. They don't know where tariffs are going. They don't know where Trump is going. But you also may be starting to see some effects of AI in terms of companies feeling they can get by with fewer people to do the same or even perhaps more work.
So, Steve, let's look more at the softening labor market. In your second chart, Chairman Powell explicitly said yesterday that was the big concern, was the softening labor market. And as you point out, for the first time since the pandemic, you have more people looking for jobs than there are jobs available.
Yeah, exactly, Willie. So before the pandemic, of course, typically we have more people looking for jobs than there are jobs. Then you had the pandemic, huge number of jobs. People could kind of get jobs very easily, and the lines have been converging. And then just last month or so, they actually crossed, and you do have more people looking for jobs than there are jobs. And so that's another sign of a weakening labor market. And then another thing that's worth pointing out is the long-term unemployed, and the number of people who have been unemployed for 6 months or more. And you can see right now we hit, and it's been jumping up, we hit about 26% of the people who are unemployed 6 months or more. Again, ignore COVID, very aberrational, but the last time we were at that level was 2016. So we're starting to have a problem not just with the unemployment rate, but with also people staying unemployed for a long time. And one of the things you also hear anecdotally is that this is a really tough hiring season for young college graduates. Again, for the reasons I said, companies are just holding back, or they think at these entry-level positions they might be able to do more with AI. So it's going to especially affect young people.
It's really hard. And let's talk about inflation. While it may not have been as much a consideration here, it feels like it's getting worse, or at least not getting better.
Yeah, Mika, you're absolutely right. And what's interesting is that Powell pivoted sooner than he said he was going to pivot. He always said 2% inflation is our goal. We have to be at 2% inflation. That's where we're going to get to. And then as the jobs market is weakened, and the Fed does have this dual mandate of worrying about both, he pivoted. And so if you look at his inflation projections, you can see, as you said, inflation has been nudging upward. And the Fed actually thinks it could continue to nudge upward as we've not felt the full effects of the tariffs. And then it gradually declines, but it does not get to its 2% target until out in 2028 now. And so the Fed has decided whether pressure from Trump had any effect or not, we don't know. Powell is a pretty resolute guy and has been very firm in saying it didn't. But nonetheless, they've decided to prioritize jobs and accept a bit more inflation than they expected. Now, the other thing that the Fed projects every 3 months is growth. And here, again, the growth projections when you go March, June, September have been jumping around, in part because of what I was talking about before, Liberation Day, tariffs on, tariffs off, and so forth. But the big takeaway from this is that even whichever set of bars you like, whichever of their forecasts you like, growth is expected to remain way below where it was in 23 and 24. We had, and if you go back further, put aside COVID again, you'd find the economy growing about 2.5% a year. That's a fairly normal rate for an economy like this. Now the Fed is projecting more like 1.5% going forward all the way to 2028. And Trump has said that slow growth now is simply setting the stage for faster growth later as his policies take effect, a period of disruption, whatever. The Fed is saying not so fast. We think there could be a little bit more growth, but the Fed does not see for almost the entirety of Trump's term growth getting back to where it was during the last years of Biden and before that.
All right, Morning Joe economic analyst Steve Ratner, thank you very much. We look forward to more on this. I'm curious, Katty K, looking at the labor market and Steve's comments on inflation, it seems like a dismal time, especially for younger Americans or Americans in their 30s and 40s, trying even to buy their first house, looking for opportunity. Overall affordability, which politically, I'm thinking affordability is where Democrats need to live in developing a message and looking for solutions in the weeks and months heading up to the next election.
Yeah, and it's not even just buying their own house, Mika. It's always often renting their own house. You look at some of the inflation data, and actually some things have come down, but one thing that hasn't come down is housing, and that includes renting. You and I both have teenagers, and we have kids in our early 20s who have just come out of college. We know how hard it is for kids at the moment to find jobs, and what Steve was saying about entry-level jobs is particularly true. So you combine that with a whole generation of people who are coming out of college who have college debt, who then can't afford housing, prices are too high for them, and they can't get jobs. I think this is an area that Democrats are going to have to focus on, and you could see it in New York in the race with Mamdani, all those young people voting for him on the basis of affordability. The question for Democrats is, can they get those people excited about Democratic proposals to fix this in the run-up to the next election?